On January 3rd, 2025, something happened that should terrify every American citizen, but almost nobody noticed because the financial media buried it under headlines about tech stocks and crypto rallies. BlackRock, the world's largest asset manager controlling over $10 trillion in assets, quietly began the largest capital reallocation in modern financial history, moving approximately $2.1 trillion out of traditional American holdings and into international markets, emerging economies, and alternative assets that most Americans don't even know exist. And if you think this is just another boring financial maneuver by some Wall Street firm you've never heard of, you're catastrophically misunderstanding what's actually happening right now. Because BlackRock isn't just any investment company. They are the invisible hand that moves global markets, the shadow government of international finance, the firm that literally advises the Federal Reserve, manages pension funds for millions of Americans, and has more economic influence than most countries on Earth. So when BlackRock moves $2.1 trillion, that's trillion with a T, roughly equivalent to the entire GDP of Italy, out of America, they're not making a casual portfolio adjustment. They're sending a signal that the smart money has fundamentally changed its assessment of America's economic future. And that signal is a five-alarm fire that nobody wants to acknowledge, because acknowledging it means confronting some deeply uncomfortable truths about where this country is actually heading. Let me take you inside the world of BlackRock, because to understand what this capital flight means, you first need to understand what BlackRock actually is, and I can promise you it's not what you think. Most people imagine investment firms as groups of Wall Street traders yelling on trading floors, but BlackRock operates at a completely different level. They're not traders. They're the architects of global capital allocation. They don't gamble on stock prices. They literally shape which companies survive, which industries thrive, which governments can borrow money, and which currencies hold value, and this power comes from one simple fact. BlackRock manages more money than the GDP of every country on Earth except the United States and China. We're talking about $10.5 trillion in assets under management as of 2024, which means when BlackRock decides to move money, entire markets shift. When they decide a sector is finished, that sector dies. When they decide a country is investable, capital floods in. And when they decide a country has become too risky, well, that's exactly what we're watching happen to America right now. BlackRock was founded in 1988 by Larry Fink, a bond trader who had just spectacularly blown up at First Boston, losing the firm millions on mortgage-backed securities because he failed to properly hedge interest rate risk. And instead of being blackballed from the industry like most people who lose that kind of money, Fink had a realization that would change global finance forever. He understood that the future of investing wasn't about human intuition or gut feelings. It was about data, algorithms, and risk management systems so sophisticated they could model every possible scenario before making a single trade. So he founded BlackRock with a proprietary risk analytics platform called Aladdin, which stands for Asset Liability Debt and Derivative Investment Network. And Aladdin was revolutionary because it could analyze millions of data points in real time, assess risk across entire portfolios, model market scenarios, and essentially give BlackRock information asymmetry over every other player in the market. And here's the thing that most people don't realize. Aladdin isn't just used by BlackRock. It's licensed to pension funds, insurance companies, sovereign wealth funds, and even governments around the world, which means BlackRock can literally see capital flows and risk positions across the entire global financial system in a way that no one else can. They have a God's eye view of global finance. And when you have that kind of visibility, you don't react to market changes. You anticipate them, and sometimes you create them. By the early 2000s, BlackRock had grown into a colossus by making a series of brilliant acquisitions, buying up competitors, absorbing their assets, and most importantly, positioning themselves as the go-to crisis managers for governments and central banks during financial emergencies. And this is where BlackRock's power becomes truly frightening. During the 2008 financial crisis, when the entire global banking system was collapsing, the U.S. Treasury and Federal Reserve didn't turn to other banks or government agencies to help manage the crisis. They turned to BlackRock. Specifically, they hired BlackRock to analyze and value the toxic assets that were destroying banks like Bear Stearns and AIG, essentially giving BlackRock unprecedented access to confidential financial data from collapsing institutions, while simultaneously allowing BlackRock to influence which assets the government would buy and at what prices. And if you think there might be a conflict of interest in having the world's largest asset manager advising the government on purchases that would affect BlackRock's own portfolio, congratulations, you're paying attention. But that conflict didn't stop the government from giving BlackRock even more power. After 2008, BlackRock became the unofficial fourth branch of financial government, working so closely with the Federal Reserve and Treasury that the line between public policy and BlackRock's private interests became effectively invisible. During COVID-19, when the Fed needed to implement unprecedented market interventions, including buying corporate bonds for the first time in history, who did they hire to manage the program? BlackRock, giving them the power to essentially choose which corporations would receive Federal Reserve support and which wouldn't. And during this time, BlackRock's assets under management exploded from around $7 trillion in 2019 to over $10 trillion by 2024, meaning they added $3 trillion in assets in just 5 years, growing faster than most countries' entire economies. And this growth gave Larry Fink and BlackRock's executive team influence that extends far beyond finance. They now have the power to push social and political agendas through what they call ESG investing, which stands for environmental, social, and governance criteria, meaning BlackRock can essentially force companies to adopt specific policies on climate change, diversity, labor practices, and corporate governance by threatening to divest their massive holdings if companies don't comply. And whether you agree with these policies or not, you should be deeply concerned that an unelected private asset manager has accumulated the power to shape corporate behavior across the entire economy based on their own ideological preferences. Because that's not capitalism, that's not democracy, that's a new form of corporate feudalism where money concentration equals political power, and the people making these decisions don't answer to voters. They answer to their largest clients, which are predominantly foreign governments, sovereign wealth funds, and ultra-high net worth individuals who don't necessarily share American interests. Now, here's where things get really interesting and really concerning. In late 2024, BlackRock's leadership, particularly Larry Fink and the firm's chief investment strategists, began making increasingly bearish statements about U.S. fiscal sustainability, specifically warning about the debt-to-GDP ratio crossing 130%, the growing political dysfunction in Washington making it impossible to address structural deficits, the weaponization of the dollar through sanctions potentially accelerating de-dollarization, and most ominously, what Fink called the end of American exceptionalism in global capital markets, which is Wall Street speak for, we no longer believe U.S. assets are the safest place to park money. And when the world's largest asset manager says that, they're not making a political statement, they're describing their investment thesis. And their investment thesis determines where $2.1 trillion gets deployed, and apparently, that place is no longer America. The mechanics of how BlackRock moved this capital are complex but important to understand because it reveals their actual concerns. Approximately $800 billion has been reallocated to emerging market equities and bonds, particularly in Southeast Asia, India, and believe it or not, select African markets that most Americans couldn't find on a map. Another $600 billion has moved into Chinese assets despite all the geopolitical tensions, suggesting BlackRock believes China's economic trajectory is more predictable and stable than America's political trajectory, which should be absolutely shocking to anyone who's been following the anti-China rhetoric in Washington. About $400 billion has been deployed into European assets, particularly German manufacturing, French utilities, and Nordic green energy infrastructure, signaling that BlackRock sees Europe becoming more fiscally disciplined and economically competitive than the United States. Roughly $200 billion has moved into physical commodities, precious metals, and inflation-protected securities, which is a classic hedge against currency debasement and fiscal irresponsibility, and the remaining $100 billion has been allocated to alternative assets including private equity, real estate outside the United States, and even cryptocurrency infrastructure, representing bets on decentralized finance potentially replacing traditional dollar-denominated systems. And when you add all this up, the message is crystal clear. BlackRock is systematically reducing their exposure to U.S. government debt, U.S. equities concentrated in overvalued tech stocks, and dollar-denominated assets generally, which means they're betting against American economic dominance continuing in its current form. So what does this actually mean for average Americans, for people who don't spend their days thinking about capital flows and asset allocation? It means several things, all of them bad. First, when the world's smartest money is leaving America, the dumb money has to eventually follow, and the dumb money includes your pension fund, your 401k, your state government's retirement system, all of which will eventually be forced to reduce their U.S. equity exposure and move into international markets just like BlackRock is doing. But they'll do it later, at worse prices, after BlackRock has already positioned themselves in the best opportunities. Which means average Americans will suffer worse returns on their retirement savings, while BlackRock's wealthy clients benefit from getting out early. Second, when massive amounts of capital leave U.S. markets, it puts downward pressure on asset prices, which sounds abstract until you realize that includes the value of your home, your stock portfolio, and every American company's ability to raise money for expansion and hearing. So this capital flight will manifest as job losses, stagnant wages, declining home values, and reduced economic growth. But it will happen slowly enough that politicians can blame other factors, and most people won't connect the dots back to this moment, when BlackRock decided America wasn't worth the risk anymore. Third, and this is the most insidious effect, when faith in U.S. assets declines, the dollar's status as global reserve currency gets called into question, and that reserve currency status is the only reason America can run trillion-dollar deficits without immediate consequences. It's the economic equivalent of a cheat code that lets us print money to fund government spending without triggering immediate inflation or currency collapse. But that cheat code only works as long as foreign governments and investors are willing to hold dollars and dollar-denominated assets. And if BlackRock's capital reallocation signals that sophisticated investors no longer believe in dollar supremacy, then foreign central banks will start diversifying away from dollars, which will eventually force the Federal Reserve to raise interest rates dramatically to attract capital. And higher interest rates mean more expensive mortgages, car loans, business loans, credit card debt, student loans. Basically everything that Americans borrow money for becomes more expensive at exactly the moment when wages are stagnant and economic growth is slowing, creating a vicious cycle that ends in stagflation or worse. Fourth, there's a national security dimension that nobody's talking about. BlackRock's investment decisions shape which countries have access to capital, and therefore which countries can develop their economies, build infrastructure, and increase their geopolitical power. So when BlackRock moves $600 billion into Chinese assets, they're not just making an investment decision, they're functionally financing America's primary strategic competitor, giving China access to capital that will be used to build belt and road infrastructure, develop military technology, and expand China's sphere of influence. And yes, BlackRock will argue they're fiduciaries obligated to generate returns for their clients regardless of geopolitical considerations. But that argument exposes a fundamental problem with having allowed a private asset manager to accumulate so much power that their investment decisions can effectively override national interests. Because BlackRock's clients are global, not American, and their loyalty is to returns, not to any particular country's success. Now, let's talk about why BlackRock is actually doing this, because the official explanation they're giving, seeking better risk-adjusted returns in a diversified global portfolio, is technically true but deliberately misleading. It's corporate PR speak that obscures the real reasons, and those real reasons are much darker. BlackRock's internal analysis suggests that American political dysfunction has become terminal, not temporary, meaning they don't believe there's any realistic scenario where Washington solves the structural problems of deficit spending, entitlement obligations, infrastructure decay, and political polarization. They've modeled scenarios where the debt ceiling becomes an annual crisis, where credit rating downgrades cascade, where political paralysis prevents any meaningful fiscal reform. And in all these scenarios, holding concentrated U.S. asset exposure becomes increasingly risky, so they're getting out while they can still get good prices. Additionally, BlackRock sees the weaponization of the dollar as strategically short-sighted and financially suicidal. Every time the United States uses sanctions, asset freezes, or SWIFT system exclusions to punish adversaries, it teaches those adversaries and neutral countries that holding dollars makes them vulnerable to American political whims. And this has accelerated the development of alternative payment systems, currency swap agreements, and most significantly, motivated countries like China, Russia, India, and even American allies to reduce their dollar dependence. And BlackRock understands that this trend is irreversible, that once countries build the infrastructure to trade without dollars, they won't voluntarily return to dollar dependence even if political relationships improve, which means the structural demand for dollars and dollar assets is entering permanent decline, and BlackRock is positioning ahead of that decline. There's also a demographic argument that BlackRock finds compelling. America's most productive generation, the baby boomers, are transitioning from being net investors to net withdrawers from the market as they enter retirement, meaning instead of contributing to 401ks and building wealth, they're selling assets to fund retirement expenses, and this demographic shift creates a structural headwind for U.S. asset prices that will persist for decades. Meanwhile, emerging markets have younger populations entering their peak earning and investing years, creating natural demand for financial assets in those countries. So BlackRock is simply following the demographic wave to where the growth will be rather than staying concentrated in an aging economy with declining productivity growth. Perhaps most controversially, there's evidence that BlackRock has lost faith in the Federal Reserve's ability to manage monetary policy without creating either runaway inflation or devastating deflation. During COVID-19, the Fed's balance sheet exploded from $4 trillion to $9 trillion in less than 2 years. They printed more dollars in 2021 than existed in the entire U.S. economy in 1980. And while inflation initially seemed contained, BlackRock's models suggest that monetary expansion of that magnitude has consequences that manifest over longer time horizons than most economists acknowledge. Specifically, they're concerned that the Fed has created asset bubbles in stocks, real estate, and bonds simultaneously, that there's no way to deflate these bubbles gradually without triggering a cascade of selling, and that when the crisis comes, the Fed's only tools, printing more money or raising rates dramatically, both lead to catastrophic outcomes. So BlackRock is reducing exposure to Fed-dependent asset classes and moving into assets that aren't tied to dollar monetary policy. Now here's where this story intersects with something even bigger and more concerning. BlackRock's capital reallocation is happening at exactly the same time that other major institutional investors, sovereign wealth funds, and ultra-high net worth individuals are also reducing U.S. exposure, suggesting this isn't just BlackRock's unique analysis, but rather a consensus forming among the world's most sophisticated investors that American economic dominance is ending. We're seeing Saudi Arabia's sovereign wealth fund diversifying away from traditional dollar assets. Seeing Chinese investors who spent decades buying U.S. real estate suddenly selling. Seeing European pension funds reducing their U.S. equity positions. Seeing Japanese investors who religiously bought U.S. Treasury bonds for decades now preferring other sovereign debt. And all of this is happening quietly, without major headlines, without political debate. But the cumulative effect is that the foundation of American economic power, the world's willingness to hold our assets and lend us money at favorable rates, is eroding in real time. And when that foundation crumbles completely, the adjustment will be brutal. The historical parallels are terrifying if you know where to look. This is almost exactly what happened to the British pound in the 1950s and 1960s, when Britain was still technically a global power, but sophisticated investors started quietly moving out of pound-denominated assets because they could see that Britain's fiscal situation was unsustainable. Its empire was dissolving, and its political system couldn't make the hard choices necessary to maintain economic competitiveness. And those investors were right within a generation. Britain went from global superpower to economic basket case requiring IMF bailouts, and the people hurt worst were ordinary British citizens who saw their savings devalued, their standard of living collapse, and their country's global influence evaporate. And the crucial thing to understand is that this didn't happen because of a war or natural disaster. It happened because of capital flight, because the smart money left and everyone else was left holding increasingly worthless assets. And that's the exact risk America faces now, except on a much larger scale because our economy is more interconnected, and the fall from global reserve currency status will be more catastrophic than Britain's decline from empire. So what can be done about this? The honest answer is probably nothing. At least nothing that's politically feasible. Stopping BlackRock's capital reallocation would require addressing the fundamental problems that motivated it, meaning the United States would need to dramatically reduce deficit spending, reform entitlements, rebuild infrastructure, restore political functionality, reduce debt, and rebuild global faith in American institutions. But every single one of those things requires political courage that our current system doesn't reward, and structural changes that powerful interests will fight viciously to prevent. The defense contractors don't want spending cuts. The elderly don't want entitlement reform. The politicians don't want to make unpopular choices that might cost them elections. The financial sector doesn't want regulations that might reduce their profits. And the public doesn't want to hear that America's best days might be behind us. So instead, we'll probably continue with the status quo: deficit spending, political dysfunction, monetary expansion, and gradual decline, until the crisis becomes so acute that change is forced upon us by market collapse rather than chosen through rational policy. And by then, BlackRock and the other sophisticated investors will already be positioned in whatever comes next, while ordinary Americans will be left dealing with the consequences of decisions made by elites who saw the problems clearly but chose profits over patriotism. The really frightening implication of BlackRock's move is what it says about elite consensus regarding America's future. These aren't ideologues or doom and gloom pessimists. These are cold, calculating financial professionals whose only obligation is maximizing risk-adjusted returns. They don't make massive reallocation decisions based on feelings or politics. They make them based on rigorous quantitative analysis of every possible scenario. And that analysis has concluded that holding concentrated U.S. asset exposure has become an unacceptable risk, which means they've fundamentally stopped believing in American exceptionalism, stopped believing that America's problems are fixable within any reasonable time frame, and started treating the United States as just another declining power whose best investment opportunities lie elsewhere. And if the people with access to the most sophisticated financial models and information in the world have reached that conclusion, maybe the rest of us should pay attention, because they're not trying to crash the system. They're just trying to avoid being in the system when it crashes on its own. And the fact that their defensive positioning involves moving $2.1 trillion tells you exactly how big they think the eventual crash will be. And if you're an average American with your life savings in a 401k, a mortgage denominated in dollars, and a government that can't stop spending money it doesn't have, you might want to start thinking very seriously about what BlackRock's actions mean for your future. Because when the world's largest asset manager quietly abandons ship, smart passengers start looking for lifeboats instead of rearranging deck chairs. And the tragedy is that most Americans won't realize what's happening until it's far too late to protect themselves. Because our media is too fragmented, our politicians are too compromised, and our financial literacy is too poor to process what a $2.1 trillion capital reallocation by BlackRock actually signals about the structural collapse that sophisticated investors are now positioning for. And by the time this becomes obvious to everyone, the best exits will be taken, the best opportunities will be captured, and ordinary people will once again be left holding the bag, while the elite class that created and profited from the problems has already moved their wealth to safety, which is not a conspiracy theory. It's just how capitalism works when you concentrate enough economic power in entities like BlackRock that operate beyond democratic accountability and owe loyalty only to their highest-paying clients. And if that makes you angry, good, it should, but anger without understanding is useless. And understanding without action is cowardice. So the question is, now that you know what BlackRock's $2.1 trillion exit from America actually means, what are you going to do about it?